This episode of the BlockHash Podcast is brought to you by Sumsub, the leading full-cycle verification platform built specifically for the crypto industry. Trusted by 8 out of the 10 biggest global exchanges, Sumsub helps VASPs, exchanges, and DeFi platforms prevent fraud, stay compliant, and scale globally, all without slowing down user onboarding. With instant KYC and KYB, automated crypto transaction monitoring, and full travel rule compliance across a network of more than 1,800 VASPs, Sumsub adapts fast to evolving threats and regulations. They verify over 14,000 document types worldwide and onboard users in under 20 seconds, achieving conversion rates up to 95% plus in key markets. If you want secure growth and a frictionless onboarding experience for your users, visit sumsub.com to learn more. What's up, guys? Welcome back to another episode of the BlockHash Podcast. Here in 2026, we're doing our first in-person interview, part 3 with Matt Carr, I believe, who's back on the show. Matt, how's it been going? How's your holiday break been? How's life?
Oh, doing great. Thanks for having me again. Holidays were great and exciting start of 2026 here.
Yeah, a lot going on in 2026. We're opening a studio, as you already know, and so we got all the equipment and we're kind of working through some kinks here and there. So if there's anything that happens with the episode today, don't worry. We're working through some things. But yeah, excited to get that open here in a couple months. And I'm sure you guys have been hitting the ground running as well and been doing quite a lot. Maybe get us caught up on where you guys have been at the beginning of the year. Maybe we can recap a little bit of last year too. What's kind of your focus just heading into the new year?
Sure. I think, in general for the crypto space, it was a year that wasn't so centered on price as it was access. And there were a lot of new vehicles made available to the public, especially domestically here in the form of ETFs that brought millions of new participants and investors to the table. Mm-hmm. It was a year of a lot of constructive regulatory change and update that's ongoing. I'm sure we'll discuss some of that at some point. It's also a year of institutions increasingly getting involved. So I was very constructive on how 2025 went. I think it was kind of laying a foundation for us for 2026. This year has been off to a bit of a volatile start for us. That's pretty exciting. Mm-hmm. And, we're kind of in the thick of January here, looking forward a few months.
Absolutely. Absolutely. Before we talk about 2026, maybe we should talk about 2025 and some of the things we saw there. Maybe we can start with Bitcoin and some of the ETFs, maybe recap a little bit of what was happening in hindsight. I'm curious if you think that it has changed maybe a little bit the investor behavior in the industry. We talked about this a little bit earlier before we even jumped on the podcast. It's not the same as it used to be in the past where it's like heavily retail driven. Now there's institutions involved, there's governments involved. You have different players, different kinds of money in this space. What are those things that we've seen change in the past year?
The advent of ETFs has definitely led to a turnover of the participants. As you mentioned previously, crypto had individuals that by and large were the preponderance of the people transacting and using these assets. ETFs, people now can have them in their IRAs and they can get exposure through their brokerage accounts. One thing, especially in Bitcoin, people highlighted last year were old wallets that were selling huge amounts of Bitcoin. And if you think about it, it was really the first time that someone who had had Bitcoin from 2011, 2012 realized tremendous gains. It was really the first time that they had the opportunity and the liquidity to sell $1 billion of Bitcoin without crashing the entire market. So I think there's been a turnover of the participants. I think ultimately it broadens the base and it lays a foundation that we can grow off of. I think that was a really big deal domestically here and internationally. There are products too, ETPs, ETFs, different securities that are made available through brokerage platforms. And on the retail side, that's huge. So I'm not surprised to see a change in maybe sentiment and also a change in the volatility. That's another thing that we spend a lot of time thinking about and paying attention to. But there's a bit of a growing pain to what's happening here in a transition that probably will take some time to work through.
Yeah, I do imagine it taking some time just because of the origins of this industry and where it's come from and what it's kind of shape-shifting into now. But we still saw a lot of different trends last year come among a lot of the different blockchains and cryptos and different types of assets that are emerging in the space. And then some old legacy ones too. We saw a lot of movement around Zcash and the privacy side of the industry. We saw a lot of movement around Ripple and remittance focused chains, as well as Solana becoming such a massive ecosystem now, getting to the point where it may even overtake Ethereum in terms of dApp development and liquidity being locked up on chain. Whether it's one of those or some other things that maybe you've noticed, where have you seen some maybe trends start to occur last year that could carry over into this year?
You mentioned Zcash. That is kind of a theme around privacy on chain that has been around in the crypto space for years. There's also Monero. It certainly gained traction and broader acceptability. It started to trade on exchanges this past year. It did well price-wise for the year. That certainly has been a trend that's gained some traction as of late. I would also say from a foundational level, the institutions building on top of the blockchains was something that really accelerated in 2025. So you have the New York Stock Exchange talking about tokenizing stocks. You have JP Morgan Chase tokenizing funds and vehicles, and they're using Ethereum and they're using Solana. So it's interesting to see that these platforms, these technologies are being utilized by large institutions. And at this point, they're still somewhat agnostic. It doesn't appear from a standpoint of base technology, there's a clear winner yet. So there's a real competition there for the layer one level there. But Bitcoin stands alone as the largest, most liquid commodity, digital property. And that traded with relatively low volatility for the year, but increased adoption for nation states, for companies, more treasury companies. That was a huge phenomenon of 2025. And I expect that to continue too.
What did we see in terms of regulations last year as well? I know that we had the Genius Act, which was probably the highlight of the year, giving clarity to stablecoins. Other than that itself, or if you even want to piggyback off of that, what are some regulatory wins, I guess, that we had in 2025 that you also think will further reflect going into 2026?
I think the calling off of the dogs, Operation Choke Point 2 ending, where it wasn't just an attack on the industry, it was an attack on the service providers of the industry. Banks that provided services to crypto, insurance companies that provided insurance to crypto. So that change, that 180, really allows people to take a step back and plan longer term. Previously, just some of the cases brought even against individual developers in certain scenarios, it was pretty scary for the industry. Hard to plan around. You didn't know what things would look like a year or two out. So the regulatory environment has totally changed. Some of the bills have been, I think, generally constructive. The Genius Act. There's no question that the United States has an interest in regulating and thinking about these stable coins, which predominantly are dollar stable coins, not euro or yen. And they're taking into account monetary policy and fiscal policy. And we could discuss it more at length, but essentially the largest ones are buying T-bills, government debt. And I think that the US government now is feeling that probably on the whole is positive to have a large buyer at market for that and providing a framework for that, along with other digital commodities like Bitcoin and the derivatives on top of Bitcoin and Ethereum. So in my view, this is a very positive situation that we're looking at and we're working through, and it's still ongoing.
Now, looking at 2026 with all these different things that are at play today, with digital assets being even further integrated into society in all these different institutions and nation states and companies offering different solutions on them as products or services, and hopefully getting to a point where it is mainstream as a front end or even a back end technology. How do you see this affecting global monetary policy going forward, which it completely changes the way our financial system works. We're talking about 24/7 stock markets now. We're talking about having crypto-based bank accounts at Bank of America or JP Morgan, tokenization of every stock, real estate, secondary market you can think about. All of this has a completely different effect on, I guess, how we look at monetary policy going forward in a digital age. Do you have any thoughts on that and maybe what we should consider going forward in terms of how we shape monetary policy?
I feel as though we're starting to have very serious conversations because now it's clear that the technology to upgrade the rails of all of our financial world, custody, stocks, foreign exchange, and of course, monetary policy. Now we know that we have the tools and the capability to do it. And I think that's going to lead us to some interesting places. On the stablecoin front, this is in an ongoing negotiation situation with regulators, market participants, and constituents. And it really asks, at the core of it is the question, what is money? Who issues it? What is its nature? And I think people might be surprised to learn that the preponderance of dollars are already digital. I think maybe 2% of dollars that exist are physical in nature, bills. So it's already digital. It's just a question of where do those digital dollars reside? And the current situation is on databases of central banks and private banks, companies essentially. Whereas with crypto and stablecoins, you have centralized entities. These would be Circle, USDC, Tether, USDT, where they centralize and issue these tokens and they buy assets, maybe T-bills behind them. Mm-hmm. But then you also have decentralized stablecoins. To me, this is a very interesting place and a potential spot of growth as people think more about digital money, digital assets, where you just have a protocol running and you can collateralize against crypto assets. These would be like FFX protocol. They issue FX, USD, Liquidity. They issue Bold. Of course, one of the early ones was Maker and issuing DAI. That's something people can look into and see that there are a lot of people coming at this core question of what is money in the digital age and what can we do to provide outlets for people to participate. We now live in a world where anyone essentially in any country can spin up a protocol and issue a dollar stable coin. That's kind of a profound idea because the United States government is used to mandating fiscal policy via the Treasury, and also all the KYC AML, and monetary policy via the Federal Reserve. That's the interest rate policy and money supply policy, you would hope. And losing the reins on some of that and allowing that to grow and be issued in a decentralized manner is kind of a new landscape, a new world, but it's exciting.
Yeah, and there's a lot of people trying to grasp that landscape right now and fully understand what that's going to mean for everybody. And I think what we should talk about also is the fact that stablecoins aren't just decentralized, they're also centralized. And there's so many different kinds and different denominations of them and what they're backed by. You talked about it a little bit and abbreviated on that. But maybe tell us, maybe in terms of where there are maybe some differences but similarities, maybe where there's some benefits and drawbacks between the two. What do people need to know about stablecoins when it comes to the ones that are centralized versus the ones that we are familiar with today, like USDC and Tether and some of those?
I think it's a matter of perspective, and it's just a question of who you're asking on behalf of. For a user, you want something that's stable. You want something that you feel is comfortable in its backing, or at least that you trust to the extent that you're willing to hold it and transact in it. Ease of use is important. If you're a government, you want oversight and you want visibility into it. You want regulatory reach. So I'll give an example. The recent situation is in Venezuela. It turns out that Venezuela was trading in some Tether, USDT. It peers for some of their oil revenues. And the United States was able to contact Tether and freeze some of those addresses, some of those tokens, not addresses. So that is an example of a stable coin that is centralized. And essentially a company can go in and freeze these just as they would a bank account. So it's, in that regard, it's very much like a bank. Wells Fargo can freeze your deposits. They do have great reach. People globally can transact in these stable coins. They are the largest. By far, they have the most transactions. It's not even close. But I can't help but feel people won't look at that Venezuela situation. Maybe outside of the United States. Maybe Americans won't care about this currently. But I can't help but feel there won't be people looking at that saying, wait a second. I want dollar exposure. I want liquidity. But I don't want someone to just pick up the phone and freeze my account. And that's where the decentralized stablecoins come in. These are just protocols like Bitcoin. And there's no company issuing them. There's no one to call. So the downside is if you make a mistake or lose them, you're out of luck. But the positive there is no one else can freeze you out and you can participate. And as I mentioned, there's a few of them that are interesting projects. I think some of them are coming up with novel mechanisms to keep their pegs in place. They tend to be very transparent. So users can just go online, and see basically the balance sheet in real time of these protocols. And there's no employees. There's nothing hiding off the balance sheet. This is radical transparency. If you think about the banking system, you think about the large banks, Wells Fargo, JP Morgan, their disclosures are tens of thousands of pages. It's gotten to the point where they're so large and complicated, complex, opaque. I don't know if there's a single human alive that understands all of that. So on the DeFi, decentralized stablecoin, you can see all the assets and liabilities in real time. And if you feel comfortable, you can participate and no one can freeze you out of it. The only thing there that you have is protocol risk, where the protocol itself might have a problem. And then you need to think about other things like, is there on-chain insurance? But I feel as though as stablecoins continue to grow, the regulatory environment's going to mature, but participants are going to be looking for different things. A guy in the United States running a business is perfectly fine with utilizing the rails of USDC or Tether, whereas someone offshore might have other concerns, and rightfully so. So I would expect decentralized stablecoins to grow at an increasing rate looking forward.
Do you think going into the future that these stablecoins will trend more towards the decentralized route, or do you think they'll trend more towards the traditional, more centralized route because of some of these different benefits? Or do you think there will always be some kind of middle ground between the two?
I think both forms will grow at accelerated rates. I think there's tremendous demand globally for synthetic dollars. People in other nations, as bad as inflation is in the United States, and we complain about it, people in other nations would love to have our issues with regard to inflation. So I think another aspect that's very interesting and just quite new is if you look at a company, Michael Saylor's talked about this. He's talked about digital commodities, Bitcoin. On top of it, his company is issuing digital credit. And now what you're seeing on top of his digital credit, which are preferred shares, this is just in the last week or two, are you have people spinning up protocols, crypto protocols that are buying his preferred shares and issuing stable coins. Now, this leads right into the current situation of the Clarity Act that's being discussed in the United States. Can stable coins pay interest? We'll see how that lands in the United States, but these tokens are essentially dollar stable coins that are going to pass on the interest from the preferred shares they buy. The preferred shares pay 11% a year, and they pay it monthly. So one of these projects I saw the other week, I think this was only maybe a week and a half ago, is going to pay you 7% in their stablecoin. The other is going to pay you almost 11%. And they're building on top of a security that Strategy is issuing. And in particular, in this case, it's ticker STRC. They call it Strike. So that's another advent of people iterating and building solutions. I think there's going to be a lot of demand for a stable coin that pays a relatively high rate of interest, so long as there's transparency as to how it's run. I think that's very important. People need to feel comfortable and they need to be able to see precisely what's going on in the protocol. But that's a really exciting area too, where people are building new solutions that even a couple of years ago weren't on the table. The tethers, the USDCs have never paid interest. They have no intention to. They take your money, they buy treasuries, they keep the interest from the treasuries, and you have a stable coin that pays nothing, which sounds a lot like a bank account, right? I mean, the banks have these deposits that an individual makes with them. They invest those deposits, or they receive interest directly from the Federal Reserve, and they pay de minimis interest to the saver. So there's quite a spread there, and we're talking about tens of trillions of dollars here up for grabs. I think the current banking system, the current monetary system, there's a tremendous amount of inertia and momentum. This isn't like a Ferrari you're going to turn on a dime. This is like a freight train, fully loaded. And it's going to take time for things to move in different directions, but there's no doubt that ultimately people are going to find these products attractive and weigh the pros and cons. So I expect them to do well, just over time, not as quickly as some might like.
Yeah, I feel like the future of yield-bearing stablecoins is going to depend a lot on the Clarity Act, which got a lot of news in the past week because Brian Armstrong with Coinbase said that he couldn't support the bill and the legislation, which kind of caught a lot of people by surprise. He made a lot of objections based on a de facto ban on tokenized equities, DeFi prohibitions, and erosion of the CFTC authority, as well as any kind of reward staking through stablecoins. What do you think needs to change in order to create proper legislation to get passed in regards to the Clarity Act, and maybe it's also importance in terms of getting yield-bearing stablecoins further legalized too in the U.S.?
I view all of this as to be expected. I mean, what we're talking about here is essentially upgrading the rails of all of finance. And there's a lot at stake. And there are incumbents who have been operating for decades, some even longer, that are very successful, have a lot of money at risk, and a lot of money to lobby. So I don't think this should surprise anyone that the process of transitioning to crypto rails is taking some time. It's a dialogue. I think the one thing that's undeniable is that technology is real. And people will want to participate if given the option and if they feel comfortable. So I haven't been too closely pressed to the headlines on this. I expect this to take time. For me, the big transition was the administration kind of doing a 180 in general. To me, that really put the wind at all of our sails and gave us the comfort to look forward and start to plan. But I think we're still very much in the middle of this. This is really restructuring banking, payment rails, digital assets. Almost no one owns a physical share of stock anymore. I had a client come in a couple years ago who had physical shares of, it was PPG, and just dealing with a brokerage firm. First of all, getting a hold of someone at a brokerage firm who even knows what to do with them.
Like physical signed
a physical
paper.
piece of paper. Yeah.
That's old
He
school.
had this since he had retired. And, he had worked at this company. And, just dealing with that, an actual bearer physical security, the system has moved on. It's digital now. So it was an interesting, painstaking process that actually ended up taking weeks. But there's just so much inertia and momentum. It's going to take time, but I think ultimately we're going to make good decisions to adopt new technology that has a lot of promise.
Are there any other technologies that you think pair well with blockchain and crypto that may even help facilitate its success in the future?
Derivatives. Derivatives are very important because derivatives allow a larger footprint to participate, and you can curtail volatility. This is a really important tool. So this would allow larger entities to start to get involved if their concern is price volatility, for instance. That can largely be mitigated. And this is like a set of tooling that's being built and growing greatly at a fantastic rate that maybe the individual investor isn't too interested in, but institutions use these tools. It's very important. So I would say that infrastructure that's being built is key.
Is it mostly for institutions that you guys are building out these strategies for? So I know you guys do a lot with Bitcoin options. I think we talked about that on our second episode last time we did one. Or is there an opportunity here for smaller investors, individuals to participate in strategies like this in the market and find other ways to kind of beat volatility, or when times are kind of up or down, or at least put themselves in a better position, have, I think, more optionality, no pun intended, with things like derivatives to, I guess, hedge the market a bit better? Like, is this mostly designed for institutions and larger players, or could smaller players tap into this?
Our strategies are designed almost entirely for individuals. Although the derivative complex you see institutions predominantly participate in, we're kind of a small, nimble player. So we're looking to move amongst these larger pools of capital and be nimble. And most of our clients are individuals. We manage separately managed accounts only for individuals, and we have a hedge fund. And that's predominantly individuals also. There can be small institutions. But we're looking to be nimble and move in these huge areas and take advantage of them and hedge some of the downside and be aggressive to the upside.
Are there any emerging areas in the crypto world that you're excited about going into 2026, whether you saw them last year or you're kind of forecasting and looking at this year, that you think will be very prominent or that will take up a lot of attention?
I think dollar surrogate tokens, forms of stable coins, are going to grow at an amazing clip. I think it's something to pay attention to. Unless you invested in a Circle or somehow got equity in Tether, you can't really participate on that side. There are protocols that have their own tokens. I think that's interesting. I do think that these platforms are going to be growing at a great clip. It makes a lot of sense. And from a trading standpoint, what we do, the options market's very interesting to me. 2025 was a year where crypto underperformed a lot of assets. People watched gold up over 70%. They watched silver up over 150%. They watched the stock market perform well. And Bitcoin was down, Ethereum, Solana, many other tokens down quite a bit. And the options market has, to a certain degree, repriced upside. And when you look at calls, basically upside, in Bitcoin in particular, they're very sedate. They're priced as if we aren't going to see anything too exciting to the upside this year. Moments like this, I feel that it's just imperative. It's important to ask, what if, and to look at those and maybe just be open-minded. It's important to manage downside because, of course, crypto can move quickly both directions. But I'm, at this point, taking a very serious look 6 months, 9 months, a year forward, and structuring upside, for our clients because it's gotten so relatively cheap. So kind of taking the other side of that coin.
Are you guys looking at any other potential derivatives outside of Bitcoin for other digital assets, maybe in the near future that could be like another alternative play?
Ethereum is another. Solana, Avalanche is starting to see some volumes. In those other areas, I would like to see more volume, more liquidity for us to be able to get in and out. That's something where Bitcoin far and away is the largest and most liquid. And that's where the preponderance of what we do actually happens with regard to options. So that's still where we're focused, but that could continue to change in other areas.
What three assets are you the most optimistic about in 2026? And this could be Bitcoin and crypto and digital assets. This could be outside of that. It could be precious metals. It could be in the stock market. It could be in indexing. It could be in commodities. If you could pick three that you think will do well this year or see a lot of growth or play out very nicely, what do you think they may be?
The winner of being a platform for infrastructure, where the banks, where the stock exchanges, this is a huge market, and there's currently a battle to be the winner. You know, you have Solana, you have Ethereum. It seems like every week we're getting an announcement of someone tokenizing or building on one of those platforms.
Mm-hmm.
That's a really big deal. Another asset I would say are dollar stablecoins, predominantly used offshore. I think you're going to see a lot of growth there. Probably people will benefit from that, find ways to benefit. And third, upside volatility on Bitcoin, the right tail instead of the left tail that so many focus on, not the black swan, but the golden swans. I think that's something that you need to seriously take a look at looking forward.
And then what's on the horizon for you the rest of this year and for QCI? Are you guys working on any new strategies around derivatives and Bitcoin? Is it more or less the same and kind of growing what you guys are already working on? Or what can we look forward to? What's new to come?
The hedge fund's growing really well. We have been taking in new clients there. The separately managed strategies also have been doing well. Many of them finished up last year while Bitcoin and crypto had drawn down. So that was very positive for us. Looking forward, I'm excited to kind of think outside of the 4-year cycles of the halving cycle. I think that we have new players and participants. I think that the cycle is something very discernible that we all can discuss and discount. And, you know, the supply side is something very well known. That curve is known. It's all about the demand curve now. And price is just supply and demand coming together. So I think the demand curve functionally is changing. And to me, I think the risks around it the way we think about them might have to adjust. And so that lies in the options. So I'm optimistic about that, actually.
Interesting. Do you think the supply wins out this year or the demand?
It's always hard to say. I think long-term demand is just almost unbounded. The breadth and depth of blockchain and crypto, Bitcoin as a truly international asset is just tremendous. Any given calendar year, I think anything can happen, and sentiment can shift greatly in crypto and quickly. I mean, just like we saw in October, there were huge sell-offs on a Friday afternoon, and some things didn't really bounce back. But it's the same way to the upside, too. People can become very excited about these projects and these tokens, and they're still relatively small. I mean, this is a couple $1 trillion, the entire asset class. So, you know, there's a lot of growth ahead of us. And, you know, I'm not sure any given year, though, what that growth rate looks like. I'm just very optimistic long term.
Yeah, I'm very optimistic about this industry long term as well. I just think there's too many positives to outweigh a lot of the short-term shortcomings of the industry that happen, whether it's in the news or geopolitics or this institutional player doing this or someone saying that. Like, so much stuff that happens at a micro scale, but on the macro scale of things in this industry, there's so much to look forward to. And it's so young too, right? Like, Bitcoin's been around since 2009, 8, 9, you know, and then the majority of this market has barely been around 10 years, not even 10 years, like 8 years. Most markets need at least a decade or two to really start to mature for the first time. So it's still a very early space and it's very young, and it's cool to see such rapid innovation around a financial product as unique as digital assets. So I'm super optimistic, as always, in going into 2026, and hopefully new exciting things occur. And appreciate you taking this time to do a part 3. Part 4 will be in the actual studio. So looking forward to that. But yeah, thank you for taking the time, and it was great.
Oh, my pleasure. Thank you for having me. I look forward to seeing your studio.